Welcome to Story Behind Stock and to the investor edge you already have. What if I told you that your biggest investing advantage might be sitting right in front of you? And you probably walk past it every day? You don't need a Bloomberg terminal. You don't need a team of analysts. You don't need to predict interest rates 6 months from now. Sometimes, the first clue to a great investment is something as ordinary as a crowded restaurant, an empty shelf, a new brand your children suddenly love, or a product everyone at your workplace has started using. The strange part? Most people see these things. Very few investors connect the dots. And that difference can become an investor edge. Imagine you're walking through a shopping mall on a Saturday evening. You aren't thinking about stocks. You're looking for a pair of shoes. As you walk past a restaurant, you notice something unusual. There's a queue outside. 20 people are waiting. You look through the glass. Every table is occupied. You walk another 50 meters and see another restaurant. Almost empty. You don't think much about it. A little later, you enter a clothing store. You notice that one particular brand seems to be everywhere. People are carrying its shopping bags. Then you walk into a shoe store. One particular model keeps disappearing from the shelf. You ask the salesperson why. He says, "We can't keep this one in stock." You go home. For you, it was just another Saturday. But imagine if you had looked at that day differently. What if those weren't random observations? What if they were business clues? The crowded restaurant could be telling you that customers are choosing a particular concept. The popular clothing brand could be gaining market share. The disappearing shoe could be signaling unexpected demand. The ordinary consumer might simply enjoy the product. But the investor asks a different question. Is something changing underneath the surface of this business? And that is where our story begins. Peter Lynch understood something that many investors overlook. The economy isn't happening only inside financial statements. It is happening around you. Every morning, at the supermarket, at the petrol pump, at the airport, inside offices, on your phone, in restaurants, in conversations with friends. The customer sees a product. The employee sees a business trend. The supplier sees increasing orders. The investor sees potential information. But there is an important distinction. Seeing something popular does not mean you found a great stock. A crowded restaurant isn't automatically a great investment. A popular smartphone doesn't automatically make its manufacturer a good buy. A rapidly growing brand can still be an overpriced stock. The observation is merely the beginning. The real question is, why is this happening? And then, who is making money because of it? And finally, is the market already aware of it? That sequence turns an ordinary observation into investment research. And this is where Story Behind Stocks comes in. We don't just look at what is happening. We look for the story behind the stock. Because the investor edge isn't simply seeing something first. It's understanding what it means before everyone else does. Think of yourself as a detective. The crowded restaurant is the clue. The growing sales are the evidence. The company's competitive advantage is the explanation. The financial statements are the proof. And the stock price is the price of the entire story. That mental model changes how you invest. You stop asking, "Which stock should I buy?" and start asking, "What am I seeing in the real world that deserves investigation?" That is a much more powerful question. Because a stock tip gives you an answer. A mental model gives you a way to find answers yourself. And that is the kind of edge we want to build at Story Behind Stocks. Don't chase the stock. Find the story. The ordinary investor's advantage. Now imagine something else. You work in an industry. For months, you've noticed that one particular supplier is receiving more and more orders. Your colleagues are talking about it. Customers are asking for its products. Competitors are struggling to match its delivery times. The company is hiring. You haven't read an analyst report. You haven't attended an investor conference. But you're watching the business evolve in real life. A professional analyst might eventually discover the same trend through quarterly results. But by then, the numbers may already be visible. This is one of the fascinating ideas behind Lynch's philosophy. The ordinary investor may sometimes see the beginning of a trend before the financial statements reveal the full picture. Not because the ordinary investor has better information, but because he is participating in the economy. He is the customer, the employee, the supplier, the parent, the commuter, the consumer, the person standing in the queue. And that creates an unusual advantage. Think about it. Wall Street may spend millions trying to understand consumer behavior. You may experience it. While buying groceries, Wall Street may build models to understand which brands are gaining popularity. You may notice it when your family starts buying the product. Wall Street may wait for quarterly numbers. You may notice the change months before the numbers arrive. That's the paradox. Sometimes the investor with the biggest research department isn't the one with the earliest clue. Sometimes, the earliest clue is sitting in the shopping bag in your hand. And that's the kind of investor edge we explore at Story Behind Stocks, where everyday observations become investment insights. But now comes the dangerous part. Suppose you walk into a supermarket. You see a particular product flying off the shelves. You think, this company is going to explode. You immediately buy the stock. 3 months later, the stock falls. You wonder, what happened? The product is still popular. Customers still love it. Sales are still growing. So why did the stock fall? Because you confused a good business story with a good investment opportunity. They're not always the same thing. Imagine a beautiful house. You love the location. You love the architecture. You love the neighborhood. But the seller asks you to pay 5 times its reasonable value. Has the house become bad? No. But the investment has become bad at that price. The same thing happens with stocks. A fantastic company can become a terrible investment if expectations become excessive. And a boring company can sometimes become an attractive investment if the market is underestimating its future. The process is simple. First, you notice something interesting. Then you investigate it. You try to understand the business and what is really happening. After that, you determine what the business is worth. And only then do you make a decision. It is not about noticing something, getting excited, and immediately buying it. Its current opinion about the value of that business. Those two things can temporarily move in different directions. A company can improve while its stock falls. A company can deteriorate while its stock rises. The stock price tells you what the market is doing. The business tells you what is actually happening. And your job as an investor is to figure out whether the market story matches the business reality. At Story Behind Stocks, we don't ask only whether a stock is moving. We ask whether the business deserves to move. That's the difference between watching prices and understanding stocks. The boring company. Now imagine 2 companies. One makes electric vehicles. The other processes paperwork for businesses. Which one sounds more exciting? Obviously, the electric vehicle company. It has technology. It has innovation. It has a futuristic story. The second company sounds boring. But suppose the boring company has steady demand, high customer retention, low competition, strong cash generation, and plenty of room to grow. Meanwhile, the exciting company has enormous expectations already built into its stock price. Suddenly, the boring company becomes interesting. This is another lesson Lynch repeatedly brings investors back to. Boring doesn't mean bad. In fact, boring can sometimes be useful. Because investors love excitement. And when everyone is looking for the next revolution, they can overlook the company quietly making money in the background. And here's another principle. The market loves exciting stories. Great investors also look for boring businesses with exciting economics. Because the stock market doesn't reward you for owning the most exciting story. It rewards you for correctly understanding the relationship between business quality plus future growth plus expectations plus price. That is where the real story lies. When the stock falls. Now let's make this practical. You buy stock, because you believe the business is improving. Then the stock falls 20%. Your first instinct is, I was wrong. But stop. Ask what actually changed. Did customers disappear? Did profits collapse? Did debt suddenly explode? Did competition become stronger? Did management make a serious mistake? Did the company's competitive advantage disappear? Oh, did investors simply become nervous? These are completely different situations. A falling price is a signal. It isn't automatically a verdict. This mental separation can protect you from one of the most common mistakes investors make: confusing price pain with business deterioration. The market can disagree with you temporarily, but if the business thesis is genuinely broken, you need the courage to admit it. That's why conviction should never mean stubbornness. Conviction means, I know why I own this. And if the reason disappears, you change your mind. And now we arrive at the bigger lesson. The ordinary investor doesn't need to know everything. You don't need to predict every interest rate decision. You don't need to forecast GDP perfectly. You don't need to know what the market will do next Tuesday. You need to understand a smaller number of businesses. Much better. You need to develop the habit of noticing, then questioning, then investigating, then connecting the story to the numbers, then asking whether the market has already priced that story in. That's the process. Observation creates curiosity. Curiosity creates research. Research creates understanding. Understanding creates conviction. Conviction creates patience. And patience allows the economics of a great business to reveal themselves over time. That is the investor edge. Not secret information. Not prediction. Not intelligence alone. Better observation plus better interpretation plus better patience. So the next time you walk into a supermarket and notice one product disappearing from the shelves, don't immediately think, I found a multi-bagger. Ask, why is this product becoming popular? Who is benefiting? Is the trend sustainable? Is the company's economics improving? And most importantly, does the stock price already know the story? Because that's where investing gets interesting. At Story Behind Stocks, we believe every stock has two stories. There's the story everyone can see, the stock price. And then there is the story underneath, the business. Our job is to uncover the second one. Story behind stocks. Don't just follow the stock. Understand the story behind it. And perhaps that is the real advantage the ordinary investor has. You don't have to see everything. You just have to learn to see what others are overlooking. But there's one problem. Suppose you discover a company that is growing rapidly. Customers love its product. Sales are accelerating. The business is expanding. Everything looks perfect. You think you found the next big winner. Then you look at the stock price and discover that everyone else has already found it. The market is already expecting extraordinary growth. So now comes the question that separates a good company from a good investment. How do you know when the story is already priced into the stock? Because sometimes the best company isn't the best stock to buy. And sometimes the company nobody is talking about is exactly where the biggest investor edge is hiding. That's the story we're going to uncover next. Story behind stocks. Because the real opportunity isn't always in the story everyone is telling. It's in the story the market hasn't understood yet.